Now, energy and commodity markets have been volatile over the past few years against a backdrop of higher for longer rates, the economic slowdown in China, and two wars on the global stage. Well, in just a moment, we'll be joined by Commodities veteran Jeff Currie for a deep dive look at what's happening in the sector and what's coming next. And then a little bit later in the show, we'll also look at commodities and inflationary pressures. But let's begin with a focus on the oil markets. Now, prices have rallied since late last year on escalating tensions in the Middle East. Some analysts say that $100 a barrel is back on the cards. Well, joining us now, I'm delighted, is Jeff Currie, Chief Strategy Officer of Energy Pathways at Carlyle, a former head of commodities research at Goldman Sachs. I mean, you understand. Welcome to the program.
Great.
Jeff, you understand these commodities really like no one else. I want to get your thoughts on oil off the highs. Does that reflect the fact that traders are less worried about the Middle East and its escalating conflict, or is it supply and demand issues?
Well, obviously, if you look at the pullback recently, we're back to levels before the events of what happened between Iran and Israel a week and a half ago. But more importantly, everything's off. Commodities are going through a consolidation period. We were beginning to price in equities, everything, this idea of rates being higher for longer. But let me remind everybody, we're talking about rates being higher for longer because growth is so good. I mean, the things you just went over just now. Private sector activity in Europe, the highest level in a year. We're seeing a reacceleration of growth across the board. And so when I think about what's going on, oil specifically in commodities, and I'll put Bitcoin in there and all the physical assets, is they're going through a consolidation period. These assets, these physical assets, are tied to underlying growth and inflationary pressures. In the bottom line, retail sales was smashing that we saw last week. You have unemployment still at very low levels. CPI surprise to the upside. Chinese manufacturing beginning to accelerate. Europe, Germany accelerating. The list goes on. This is classic late cycle expansion that you and I were talking about 3 months ago.
So what you're telling me is that there's a shift basically in the supply-demand equation.
Absolutely.
Is that right?
Well,
so where do we end up?
I wouldn't say it's so much a shift today as it was when we were talking 3 months ago. Right. What we went through in 2022 and 2023 is your classic mid-cycle pause. Yeah. The economy adjusts to the higher rates and the higher energy and commodity prices. It went through that adjustment. Manufacturing slowed down. Now we're coming out of it. And is this thing any different than a previous cycles? No.
But, Jeff, if you look at the rates expectations for the Fed, right, higher for longer, and I know this is because growth is wrong, but does it have a harmful effect on commodities at all? Looking forward.
This is why why you want to own commodities in this environment, because if you don't have a situation in which you're raising rates because of strong underlying growth, means commodities are going higher, and that's what's going to force their hand to raise rates. And if they do cut rates, you're adding more liquidity into the system, which means higher commodities. So commodities are a win-win in this situation. That's why they nearly always outperform all other asset classes in this environment.
But I'm looking at the IEA. They're predicting further slowdown in oil demand growth next year to just 1.1 million barrels a day, right, as we get closer to peak demand. Do you agree with that assessment?
By the way, when we look at late cycle commodities, there's a really important point. It's not the growth that matters, it's the level that matters. And why do I say that? Is because as the level of commodity demand goes up, it stresses the underlying supply level. So yes, the growth rates are going to slow. Right. And that's what you happen late, but the level could continue to grow, stresses the system, puts upward pressures on prices. So that, and by the way, the equities, which are tied to growth rates, they begin to come down. So this is what I always argue over and over with commodities. They are tied to the level of activity, while financial markets are tied to the growth rates of activity, which is why you get the outperformance.
OPEC Plus has kept supply tight.
Yes.
Is this about to backfire?
No, when we look at where, first of all, everybody's talking about all the spare capacity in the system. It sits in Saudi Arabia and UAE. Right. That's it. And they have more market power today than they've ever had because of a lack of investment in many of the different non-OPEC countries. And yes, you're probably going to respond back that rapid growth in the U.S., but compared to what's going on more broadly, it's relatively small. Then I think the other issue that gives them market power is that you have inelastic demand because we've taken out all the low-hanging fruit. So that group that sits on that spare capacity has more market power today than they've had since the existence of OPEC.
So does oil, is it $80 or $100 next?
We're far closer to 100. I'm not in the forecasting business anymore, but everybody goes, wow, we're going to hit 100. By the way, the one thing I learned in all my time of looking at these commodities, trade the wings. This thing's going to, when it goes, and when it drops, it drops. And you've been doing this as long as I have. So the odds of this thing going over 100 are extraordinarily high. The question is, how high can you get before you start to see OPEC begin to adjust the system? By the way, I want to say this, and this is just history in the 40 years of OPEC history and where we are in the cycle. Never has OPEC ever been able to bring on supply as we go into the final stretches of a economic expansion and tame the oil price. What happened? Let's go back. Were they able to do it in 2018? No. We got it up to $88 a barrel. And then we had the waivers on Iran. We could talk about that later. That's a very similar risk here, but I think it works to the upside this time around. 07, 08. And then you can go back to 01, 2000. I can keep going back all the way back to the existence. They never, because here's the point. If the rise in production misses by just 5 days, what are you going to do? You're going to get backwardation. You got to get that pinpoint, that accuracy, which is already. By the way, if there was a group in OPEC that could actually get this right this time around, I would say this, that this leadership can get it right. But again, I'm going to say you missed by 5 days because think about what happens. We know that tankers out there in the Gulf, wherever it is, it's coming into the refinery. I don't have crude today. I'm short by, let's say my inventories are 5 days. It's going to be 6 days late. I got a problem. I'm buying crude and the backwardation goes up. Also on the backwardation, another point I want to emphasize. Everybody's talking about backwardation as an indication of a political risk, geopolitical risk premium. It can't be. I always say time spreads don't lie. They tell you this market is tight. And another point, the market went off the board in backwardation. That means there's no investors in it. It's all physical. You really have a tight market here.
But, Jeff, tight market plus geopolitical risk. So let's talk about Iran. I mean, could this actually fly through the roof if something happens?
Oh, absolutely. Because, I mean, the market's unprepared.
Why is it not priced in? The market is unprepared.
But we look at more broadly. I don't care if it's energy equities, energy commodities, or more like it. There's not a large investor participation. And also, money today chases trends. They don't make bets. They don't trade. And so there's no real trend here. By the way, when it started trending, look at copper. Copper overshot the fundamentals near term. They'll trade that trend. But when we look at more broadly, most of the discretionary money can't sit there and hold a position of geopolitical risk premium betting for this thing. That said, there is activity in out-of-the-money options. You go up to that $150, $200 range. People are buying it because they're hedging geopolitical risk, inflation risk, and equity risk type premiums. So there is activity, but it's relatively small, and it's located in the options markets.
Jeff, I think J.P. Morgan is saying that it's time for a reality check on the energy transition. It's slow, costly, and not rewarding for investors. I mean, is that how we should see it?
Well, I think we're going through that reality check right now, and people are reassessing it. But when we look at the returns in the green sector, there's two things that are driving it. One, there's a hangover from the big spike we had in 2022. Let's remember that when everything exploded in 2022, coal production, it went up the size of Saudi Arabia, by the way. That's how much coal we added in that environment. Gas prices went negative in Europe. And, U.S. NYMEX natural gas and power prices reached an all-time low, 6 weeks ago. That's creating a headwind to the sector. And by the way, because we ramped up coal production. The second factor that's had a big impact on this is China. What is China doing about their property market problem? They're rotating growth into manufacturing of green CapEx goods, and they're pushing them onto the global market. And by the way, the returns aren't that great, which is the problem that the equity market has had in China. But I think the key message here is there's two drivers of that weakness. One, a hangover from that spike in 2022 in what China is currently doing. Both of these are temporary. Longer term, there is a story here. And
temporary a couple of years or temporary 5, 10 years?
By the way, it's been temporary for 2.5 years. If you look at the peak, in fact, by the way, that report Christian did, I thought was phenomenal. But he has a chart in there.
Yeah.
This has been going on for 2.5 years. It's not something that just cropped up in the last couple of days. That we're going through that rough patch. But I think the longer term outlook is still very positive for the sector.
Okay, we'll talk about that longer term outlook. Jeff, thank you so much. Jeff Currie from Carlyle stays with us for a look at some of the broader commodity themes and sectors, including also the rallying gold and metals. This is Bloomberg. Welcome back to our deep dive on the energy and commodity sector. We've looked at oil. Let's now talk about the rallying gold and metals. Now, the index of all 6 base metals on the LME has gained more than 13% this month on a better global manufacturing outlook. Investors, though, remain cautious on future moves by the Fed. Meanwhile, gold extending losses after its biggest daily decline in almost 2 years following a stunning rally in the Haven asset. Now, let's bring back Jeff Currie from Carlyle. Jeff, I want to talk to you about copper. Gold. What is gold right now?
By the way, gold is a mystery. I'm not going to say I got to, and understand it. Because if you look at the drivers, fundamentally, usually what drives higher gold are lower real rates or a weaker dollar. What are we actually seeing? We're seeing higher real rates and a stronger dollar, and typically gold goes down that. When we look at it, clearly there's a mysterious buyer out there. You can see it in the physical premia. It's most likely coming through Dubai. You see it in the OTC market. Historically, when we see that, and you get the data 3 or 4 months down the road, you find out it was an emerging market. Probably unlikely Russia. They just dig up their gold, put it into the central bank because they got so much underneath the ground. But is it China? Is it India or somebody like that? Who knows? We'll find out.
Is this a play against treasuries or trying not to buy treasury, or could it be completely separate?
I would argue it's probably an inflationary hedge. I want to emphasize gold traded like this in the 1970s. So what we're seeing here in this dynamic is not completely unfamiliar territory. You just got to go back 4 decades to see a period similar to this. So I would argue, and you look at Bitcoin too. Both of them are, the strongest performers out there. I argue they're pricing in inflation risk. Yep. But the other thing both are pricing in is liquidity problems, liquidity risk, particularly in the financial markets.
Yeah, which have come to fruition, or it's something that they're just hedging in case something's slowing down the road? We haven't really seen anything.
One thing I can say is Bitcoin's a measure of liquidity out there. And, part of the reason the volatility you've seen across the space, not only in commodities, but in financial markets, liquidity still remains low.
Jeff, talk to me about copper. So it's had quite a strong run. I think it's right on the cusp of $10,000 a ton. We talked about the energy transition. I mean, is this a signal that we could be there? I know you said, we've been waiting for 2 years and a half.
Yeah.
Like, how do you time it?
By the way, I want to point out, we got bullish on corn in 2006 off of the biofuel story. Corn didn't perform till 2012, but it went straight up. By the way, copper typically trades like a stair step, and we just went through one of the stair steps. So now the difference between copper and oil has backwardation. That's telling you it's fundamentally tight on the front end. And again, I'm going to emphasize, it went off the board in backwardation. There's no investors going off the board in backwardation. In copper, we're a little bit of contango on the front end, which is telling you it's pricing medium to longer term stories. So yes, you've had the upward draft of everything under this higher for longer, growth surprise that we're dealing with. I'm not going to call it a surprise. It's your typical late cycle.
Well, you called it.
Yeah.
But not others.
But in terms of thinking about what copper and the metals are pricing, it's pricing a more medium, longer term story, which brings us back to the whole question around energy transition, because we've always been making the argument, going back, copper is the new oil. I stand by that view, because we're going to electrify everything. You're going to need the copper to do it. And so most likely it's pricing that in. But even there, like oil, that's going through a consolidation period because the price got ahead of the fundamentals. But longer term, absolutely believer in that. And by the way, underlying demand for copper, despite the weakness in the property market in China, is still healthy. Because think about what we were just talking about. All of those green CapEx goods in China that are being subsidized. And then you have all the investment that's occurring in the West. And it really starts to accelerate in 26 and 27.
If you have the energy transition and you have AI, so as we use AI, our mobile phones get more complicated. We're also going to be, using some of the rare earths or even some of the things that you follow very close, some of these metals. Like, how do you see that complex changing?
AI is chips and copper. And what are the chips? Gallium and germanium. So it is basically critical metals and copper. So that is the bottleneck to really be able to make the investment in AI. In fact, everybody goes, well, AI and energy are the two most investable themes. Well, energy is more investable than AI because you need the energy to get to the AI. And here's a stat for you. One GPU, one of the NVIDIA GPUs, consumes as much electricity as the average American household. Now let's go start building enormous data centers. You could be up to 100 megawatts of the demand out there. So this is significant, and I really believe when we think about the forward demand or the structural story, it's more bullish today post this AI boom that we've seen over the last 12 months than it was 18 months ago.
But after decades of underinvestment, is there now danger that they're overinvesting and actually we'll have too much of it?
Absolutely not. And by the way, here's a point is, people say to me, oh, look at all the investment in green energy. And I'm going to cite a number, I think it was 2.3 trillion in the numbers that Christian, in that report he did. When you look at the need, like I know Goldman put out a number somewhere around between 15 and 20 trillion dollars this decade alone. You're not even scratching the surface of how much investment we actually need to be able to achieve this. So I stand by the underinvestment thesis. And also remember, green represents somewhere around 18% of the overall energy. Brown represents 82%, and we have not been investing in that. We're underinvested, and that's really the core of the super cycle story, or the revenge of the old economy, is that lack of investment.
Finally, I could speak to you for another 3 hours, but I know you do have business to do. Gasoline prices in the U.S., are they critical in the U.S. election year?
Absolutely, yes. And when you look at what are the most important issues facing voters, particularly in the U.S., the dominant one is the economy and inflation. And by the way, the one thing nobody's been talking about that is in that aid bill, that $95 billion aid bill, more sanctions on Iran around vessels, refining, and how they handle the Iranian crude. I would say the one way out, waivers. And remember we started this, 2018, what did Trump do? Waivers will be able to manage it as you go into that election.
So interesting. Jeff, thank you so much, as always, for giving us a little bit of your time. Jeff Currie, there's Chief Strategy Officer of Energy Pathways at Carlyle.